Welcome to another quarterly update for the third quarter of 2020 from Sharon Partners. I'm joined, as usual, though a little differently this time given the current climate, virtually by Dr. Steve Garth from his base in Sydney. Steve, welcome.
Yeah, thank you, Billy, and welcome to everyone watching our video too. Yes, at the moment, being in Sydney, can't get to Brisbane, can't get to Melbourne, but I'm hoping to be able to come up and see you and the team in person, Billy, in a couple of weeks' time.
Yeah, hopefully in the new year we can do this in person. But good to have you with us anyway. Steve, would you like to kick things off by telling us what's happened in the markets over the last 3 months?
Well, look, global financial markets actually kicked off the second half in a very positive fashion. And of course, that's because they've been supported by over $20 trillion in global stimulus. US and Euro markets had positive returns for the quarter. Australia, as we'll see in a little bit more detail shortly, it's flat for the quarter. Now, markets did have a risk-off tone in September. That's market speak for the market's got the wobbles, and particularly those large cap tech stocks that everyone talks about. They came down by about 8% in September, but over the whole quarter, they're up an amazing 30%. And for the year, they're up something like 100%. The chart I'm putting up now shows the equities and listed real estate and how that behaved over the quarter and over the year. The first column represents quarter, and the second column in each group represents the 12-month performance. And looking at Australia as measured by the ASX 300, as I said before, flat for the quarter and down about 10% for the year. Global markets, though, did a lot better. They're up about 4% for the quarter, and that's pretty much being led by the US market. The S&P 500 was up by 8.5% for the quarter. Emerging markets, they had a pretty good quarter compared to their developed market cousins. They're up just over 5% for the quarter. When we move across to the right-hand side, we're looking at the REITs now, stands for Real Estate Investment Trusts. And what you can see, not a bad result there for Australia, up just over 5% for the quarter. Of course, it's coming off a low base. When you look at Australian and global REITs over the whole year, they've been the worst performing asset classes. And no surprise, given the lockdowns that we've seen due to the global pandemic, particularly commercial real estate, obviously really suffering and will have a little while to go to recover from that. The next chart, Billy, just quickly, is the defensive part of a portfolio. That's cash and fixed interest or bonds. And you can see that for Australians, the cash rate is pretty paltry as it is sort of around the world, essentially zero return on a cash investment over the quarter. And not much different over the year, about 0.06% return. That's using something called the bank bill index to measure the Australian cash rate. When we move to bonds, though, to both Australian and global bonds, you see, a return of under 1%, about 0.6 and 0.7% respectively over the quarter. But over the year, we've got returns there of 3 and 3.5%. And that might surprise people because they're probably aware that yields of bonds around the world are very low. And yet the investment in bonds is still returning a positive return over the year. And of course, Billy, it's not a bad example of why diversifying across equities and bonds is not a bad strategy. In Australia, markets down 10%, but the bonds are up, 3.5%. So again, you're diversifying your investments, minimizing that volatility by having a diversified investment.
Perfect. And looking at the quarter and more broadly the year, I guess relatively steady from cash and bonds, as you said, and a bit more action or movement in the equity space. Can you tell us a bit more about locally the Australian market and what's happened there over the last quarter?
Yeah, I'm putting up a chart now which shows the ASX 200, and I guess that's the main index that people refer to when talking about the Australian market. And we've shaded the last quarter in there, and you can see that is quite flat, just down a little bit. Really, that's because it's the big banks have weighed the market down. The Commonwealth Bank's down about 8.5%, Westpac's down just over 6%. And that's really got to do with fears about potential for higher levels of debt. Now, companies that have got offshore growth have actually been the winners for the quarter. Afterpay, for example, has been in the news. They're up just over 30% for the quarter. Overall, when you look at the ASX 200, as we mentioned, down, in this case, down 15% for the 12-month period when you're measuring by the ASX 200. And it's down nearly 23% from its peak on the February the 20th in 2020. So we've got a ways to go to get back to the peak yet.
Thanks, Steve. So a bit of work to go for the Australian market. In the US, you mentioned it was up and a bit of a different story. What's happening there and what's driving returns there?
Yeah, so we hear a lot about the US market, and they've turned in the second consecutive quarter of really dramatic gains. It's really an historic stock market recovery. So despite that stretch of volatility in September I mentioned, the S&P 500's up 8.5% over the quarter. The chart here shows Australia and the US. The next chart, though, I want to show you the FANGs. Now, the FANGs are Facebook, Apple, Amazon, Netflix, and Google. Typically, there are other companies in there. For instance, Microsoft is there, but I guess the M just doesn't make for a good acronym. So the FANGs are a collection of these big technology stocks in the US. And you can see when I plot that on the same chart, that's up a staggering 30% for the quarter and over 100% for the year. So in fact, if I took the FANGs out of the US market, they make about 25% of the market. Australia and the US have actually performed quite similarly. It's those big tech stocks having that amazing run that are really pushing the US market higher, and for that matter, pushing the global markets higher.
Summing up and looking ahead a little bit, we've got plenty on the horizon from a financial markets and from a world news perspective. What can you tell us about what may lay ahead?
Yeah, well, let's have a look from an economic perspective, because we have a much better handle on what the economy looks like than we do on what will happen in the stock market. So the economy has seen a strong bounce from the lows that we saw in April. So recovery will be slow and it will be bumpy along the way. Underlying inflation is certainly going to remain low. There is no sign of inflation anywhere in the world at the moment. And so while inflation remains low, global and monetary and fiscal stimulus is going to remain quite large. You know, we just saw in the budget this week that governments around the world will continue to support their economies. Now, the RBA cash rate was left at 0.25% on Tuesday night, but a survey of economists around Australia indicate that they believe that the cash rate will be cut to 0.1% before the end of the year. So that is an historic low cash rate if it gets down there. And it's not likely to rise for a number of years. So expect cash rates to remain very, very low for an extended period. What I think is more positive for Australian investors and the Australian economy is that Australian assets will actually benefit from the much better virus control that we've had in this country. Very clear, very unified in providing stimulus. And despite a little bit of tit for tat lately with China, our exposure to China will also help our economy. You know, now there are uncertainties ahead, of course, which I've really already alluded to. The coronavirus and second waves or even third waves clearly could drive further shutdowns. You know, unemployment will be affected. Bankruptcies may continue. So they're the uncertainties. Lots of people talk about the US election. I see it in the newspaper all the time that, you know, the US election will cause uncertainty. To be honest, that's very short term. Financial markets really look through that. You know, Billy, we've said that many times. A lot of that news then, or a lot of that economic background I just gave doesn't seem, you know, terribly great. But you must always remember that the economy and the stock market are two different things. The economy is looking at what's happening now and looking at figures that they're getting in today. The stock market, on the other hand, looks to the future. What moves the prices in a stock market is not what we know, it's what we don't know. It's the unknown that moves those stock prices. So while we do know something about the economic conditions going forward, we have no idea what stock markets will do. And that's why we need to stay disciplined, stay diversified, stay the course.
That's it for another quarterly market update from Sharon Partners. Dr. Steve Garth, thank you once again for your time and your insight. And of course, if you have any questions or you want to reach out or anything's changed in your circumstances and you'd like to review your strategy, please contact your advisor and we'll be more than happy to help. Thanks again.
Thanks, Billy, and see everyone soon.